When you partner with Axon, you immediately gain access to a full range of products and solutions designed to meet the complex needs of today's grower. We carry all major brands and sizes of tires and wheels. We specialize in large diameter wheels for large equipment. We have one of the largest OEM replacement wheel inventories in North America. Known for extreme flotation setups, duals, and triples, we have wheels for all makes and models of tractors, sprayers, combines, and grain carts. If we don't have the wheel in stock, we'll custom build, sandblast, and paint in-house. There isn't a more vast inventory in North America dedicated to helping dealers move more iron. With facilities on the West Coast and in the heart of the Midwest, leverage our 230,000 square feet of indoor inventory to solve any problem a grower may have. Move more iron with Axon.
Moving iron.
Hello and welcome to Moving Iron Podcast Markets with Shawn Hackett. Shawn Hackett is with Hackett Financial out of Boca Raton, Florida. And he's nice enough to come on and talk about what's happening in the world of commodities. Shawn, how you doing today?
I'm good. Just getting back from a trip to Oklahoma City and to Missoula, Montana, for a couple of conferences. Went very well. Nice always to get out in the big country again, and but also nice to come back home. So,
yes, it's Oklahoma City and Missoula. That's the tell of two different cities there for sure when you start looking at geographical areas and then also what they were crop production, I guess, a little bit. So talk a little bit about what you were talking about there at your two conferences you went to.
Well, in Oklahoma City, it was the American Bankers Ag Association annual meeting.
Uh-huh.
So it was a big 3-day conference. Ton of people were there from different walks of life. You know, if anyone doesn't know, they're an organization that is heavily involved with Washington, D.C. They're stationed in Washington, D.C., so they're obviously, engaged in trying to push government into, certain directions in agriculture that they think are in the best interest of producers and farmers. And of course, my job on this particular conference, they wanted to just exclusively talk about the long-term weather patterns that and the risks, that I saw not only in the long term but also in the short term. And so, we went over that, and it was extremely well received. Most of the people, most of them will not have heard much of what I talk about with solar cycles and sea surface temperature cycles and Gleisberg cycles and Amazon, Amazon monsoon issues and that sort of thing. But it was very well received, and I think this kind of information is important right now, because these weather risks need to be correctly calibrated, not only in how one actively markets the grain or handles their inputs, but also the kind of crop insurance they use, the kind of loans they take out, and of course bankers, they have an interest in their customers paying the loans back. So obviously, if the farmers are more profitable because they're being more proactive, because they're addressing some of these weather risks, it's incumbent upon the banker and the farmer to take action, and also obviously trying to utilize more ag tech, artificial intelligence, quantum computing, drones, satellites, Internet of Things. I mean, there's a lot of things that can help mitigate some of these weather volatility risks going forward that I think will separate successful farmers from ones that get kind of left behind, are the ones that are adopting and adapting and being proactive versus the ones that keep doing things the way they were always doing. And I don't think that's going to work in the world we're heading into, at least as it pertains to climate. So,
yeah, it's going to be some of the stuff you talk about, Shawn. I've never heard anywhere else, and I still haven't heard it, even though now that we've been talking about it as long as we have. And it's the with these things that are coming down the pike, stuff you're talking about, if they happen and the things go the way you're talking about, it's going to dramatically change the way farmers do business, and not necessarily just that, just how the whole world does business when it comes to, food. And it's going to be it's not necessarily putting things into a good basket here. I mean, the United States is going to have a good opportunity to kind of rebound itself back to what it was in the 70s and 80s as far as exporting goes.
Well, one of the big things. This is my first week of new presentations for the new season of speaking. And I always refresh, as you know, an update and as weather moves along. But I definitely talk about how there's the potential for a renaissance decade ahead for U.S. agriculture, if I'm correct in ascertaining that Brazil might be entering at least a decade-long drought period where their production is going to be constrained. That's a game changer for the opportunity for the U.S. to gain exports back, gain market share back. And if we're successful in utilizing ag tech to be more efficient and mitigate some of these risks, I mean, it really could be a golden decade for U.S. agriculture after, quite frankly, very difficult period as we've been losing out to Brazil and losing out for in other ways from China and other things. So that part of the of our talk is actually pretty optimistic. Obviously, it's not optimistic if you're a Brazilian producer, but
Right.
It's just the way it's going to go. At least according to the way it looks like to me, that's just the way it's going to go at this point. There's always a winner and loser at times, and we lost for a while, but I think we could be a big winner here for a while, and that's a very positive message to bring home, to a U.S. agricultural sector that's kind of down a little bit, Casey. There's a lot of negativity out there. There's the U.S. farmer's been beat up a lot in recent years on a whole bunch of fronts, and I do think that this could help bring some optimism back in our in this important sector for the country. So
yeah, it's gonna be an interesting time. 24 is shaping up to be a very interesting year across the spectrum of what we see happening here. I mean, in the equipment side of the business, we're seeing some deflating of a bubble, coming out of COVID, where the prices got high and those kind of things. We're starting to see a big correction there. I am anticipating it's going to be interesting to watch how that plays out, because if what you're talking about happens in 24 and we see some good where the supply and demand things are still in a very on the low side of things, I'm just curious to watch how this works out. We start looking at on-farm income, and will we start setting in a quote-unquote new normal of where pricing on equipment starts playing, just because of the access to on-farm income going throughout 24? Is that going to be as bad as I'm anticipating? I guess now is the correction going to be as sharp as I think it's going to be in
well, remember, one of the big factors is who has the crop problem, right?
Exactly. Yeah.
I mean, if the U.S. has the big crop problem, high prices never compensate for a terrible crop. This. I mean, it just doesn't work that way. So if 24, if it's Brazil that has the big crop problem and our crop, I mean, let's assume that the Gleisberg cycle drought is 2025, which I believe is the more likely year. Mm-hmm. It could be 24, but let's just assume for a second it's 25. And we have not the best weather, below trend line yield crops again, but still, low 170s corn, crops that are still respectable. But we have a major crop problem and supply constriction out of Brazil. You could have very good prices and production being decent enough that farm income could actually be could surprise to the upside and be better than what the current projections are. I think that is well. As always, you have to sell the winter rally if we get it. If we get this big rally on Brazil, you have to cash sell that, or else you've not made any farm income. But assuming you're proactive during the winter months and we get this rally, my suspicion is farm income is going to turn out to be better in 24. Maybe not as good as we saw the last few years, but considerably better than what the current projections are. That would be my best guess from what I'm looking at right now. I think it might be a little bit better. I don't think it's going to be quite as negative as, the current consensus opinion is right now.
Yeah.
So,
yeah, and that's it's just going to be a fun thing to watch happen as you watch how these things progress along and what you're doing and how those things are playing out. It's going to be interesting to watch how 24 plays out. So.
And of course, it's election year.
Oh yeah.
We still have no idea who's going to be running for president on either side. From what I can see, we just have no idea. So political chaos and geopolitical chaos is gonna reign supreme in 24. Impossible to predict exactly how each thing's gonna wiggle and waggle, but I can definitely foresee some surprises on both of these fronts that can cause some increased price volatility. And remember, price volatility is an opportunity for either the end user or the producer to get economic advantage if they take advantage of that volatility. So the more volatility we see in prices, the better the opportunities are for producers who are proactive to bring more of that money home on the farm. So we you know, a lot of people fear price volatility. My view is, between 2012 and 2020, prices went nowhere. In 2015, corn had the lowest price volatility in 50 years, meaning, if we were at 5 cents, that was a big deal.
Yeah.
I don't know how you bring a whole much, there's a lot of economic opportunity in a 5 cent corn move either way. Pretty hard to bring more home from. You basically, are just looking at, things you could do in the farm to be more efficient stuff. But I mean, but when you have corn prices or soy prices that are moving, dollars up and down in a given year in terms of its overall yearly trading range, that is tremendous opportunity on both sides. And I really would, and I always try to convey that in my speeches, is that, this is not to be feared. This is to be actually embraced as an opportunity to be more profitable as a farmer. But you just can't sit on your hands and sell at harvest time. You have to be able to be active throughout the season and taking advantage of those opportunities.
Yeah, for sure. All right, WASDE report came out yesterday, and saw a few things happen. Soybeans kind of took a kick in the pants there, but I guess, Shawn, as you look at the report, what are your thoughts there?
I didn't really see anything that was a major change in the overall profile. I mean, I believe the market has traded our crops. We can argue it's up, it's down, it's this, it's that, and it's done. The market is done. We were down yesterday, but don't forget, soybeans had a rally. We had a nice rally leading into the report. So bottom line is we've traded our crop, and now what the market is doing is starting to look at South America. Remember, markets don't tend to rally during planting season, no matter how dire the weather is. They don't tend to rally much during planting season. Look at our growing season. The hottest. The driest May in 50 years. And then we had the driest June in 50 years, and we really didn't start moving the market until mid-June. And then it was a straight up shot, as you know, where we had that move out north of $6 there for a little while.
Yeah.
We're still in the planting season. So as crazy, unbelievably hot and dry it is in North Brazil, and how it's the worst start I'm aware of since we've been recording this stuff, it's still the planting season. Now you start getting into December. December for soybeans is like June. Now you start getting December and you start saying, okay, what was planted? What does it look like? And now what does the weather look like? That's when the markets start to tend to react to weather. So we're not quite there yet. But if you look at the calendar, we're almost here in mid-November. So we're not too far away from getting into where markets actually start reacting to weather. So I get a lot of calls, a lot of emails, a lot of texts of farmers who are frustrated that the market isn't reacting. And I said, I reiterate this. I said, how many times does the grain markets react to unfavorable April, May weather in the U.S.? How many times? And I go, well, it just doesn't. Then why would you expect it to be any different in South America? Mm-hmm. It won't. And it's not. Having said that, we have seen a little bit upside price volatility for soybeans, but listen, keep it in perspective. There's a time the market likes to react, and it's not planting season, but that's the bad news. The good news is we're almost into the growing season, and then that's where the excitement can get started. So I wouldn't get negative about things, but at the same time, there's still an opportunity because markets haven't moved based upon the weather. If you're, if you're on the end user side, if you're, there's opportunities here before. You don't want to start taking action in mid-December when the market is going rip-roaring to the upside, everyone telling you how hot and dry and the crop's going to be terrible. That's not the time to take proactive action. The time to take proactive action is now, when no one is paying attention or no one is really pricing it into current prices. And so that's the message is, utilize quiet dissidence to your advantage. Don't be reactive to the markets. Be proactive ahead of them, making big moves.
Right on. All right. So when you're looking at the cattle market right now, you're seeing the cattle market has had a fairly decent correction here over the last couple of weeks. Last month, really, I guess.
Yeah.
But as you're looking at what's going on there, your thoughts as we move into these winter months where we see typical beef demand start to slide a little more than normal.
Well, I mean, if you look at the feeder cattle price, it's been kind of a mini crash. I mean, it's just been the bottom's fallen out, especially on the feeder cattle market. But as you know, Casey, we've been very, very negative on cattle, for several months, and we on your show multiple times strongly encourage those on the livestock cattle side to protect downside price risk heading into the first half of the year, and the price break is certainly supportive of the recommendations that we made, not only in our show but that we make to our customers. And so I'm not surprised that the market's correcting. I think technically, if you look at where feeder cattle and live cattle are right now, where I think we're getting into some kind of a pretty strong support area. It kind of feels like we're kind of reaching some kind of a little bit of an overshoot to the downside, and we might get a little bit of a bounce potentially into the end of the year. There's always a little bit of demand that comes in for holidays, last minute purchases, that sort of thing. I'm not expecting anything going back to the highs or anything like that at all right, at this point. But I think we could get some kind of a bounce. I think this week's, yesterday's decline was, pretty nasty. It just gave me a sense of panic, of capitulation, where everyone's just throwing in the towel. That's what yesterday looked like to me in the cattle sector. So, it doesn't mean we can't go lower today, but when you start getting that kind of action in the market, it typically means you're near a washout point, and at least some kind, of a reversion, a technical bounce, a short covering rally is to be had. But I wouldn't expect it to be anything exciting. I'm not really expecting anything exciting here, Casey. Really until we get to the spring. From spring onward, on my long-term view is I will become much more constructive on the cattle market. In the meantime, I think we could have bounces and corrections and bounces and corrections, maybe a two-sided trade. And if you're someone who didn't protect those higher prices or still have a need to move cattle because you didn't, take advantage of these higher prices, the only thing I can tell you, if you're someone right now listening to the show and you're in that position, look for bounces, technical bounces along the way. Try to move your cattle out. That's the only thing I can. It's not desirable. You don't want to be in that position. But if you are in that position, use technical rallies to your advantage. And we're probably close to one now. Is my best guess. So,
yeah. Okay. All right. So there's something I've been paying attention to here for a while, just because where it was at and the different things that we saw happen. The price of oil kind of bounced around the 60s and then the 70s, and it got to the 80s, kind of stayed there. And we had this big run up here in September where we saw Brent oil get almost $100. It was like just under 96.5 or something like that, right towards the tail end of September. And then you look at where it's at today, and we've seen about a $16 or $17 decline in the price of oil over the last basically month or so. Right now, you're looking at oil yesterday closed. Brent oil closed yesterday right at 79.54. That's a pretty big drop in a month, considering how steady oil has been in the trading areas that it's been in. I guess, Shawn, as you look at this last 30 days of oil, what are your thoughts there, and where do you see that kind of heading?
Yeah, I want to be clear. I'm never one that tends to be a conspiracy theorist. I try to stick to objective data crunching. You know how I operate. I try to stick to the facts and only the facts and nothing but the facts. Having said that, we know crude oil to a large degree is an insider's market. It is. An election year is coming up. I don't believe high energy prices are what the current administration would like to see in an election year. And it's very interesting that Secretary Blinken about a month ago went over and did kissy huggy with the House of Saud, and then they magically made a trip over here to do kissy huggy. And I don't know what was discussed, but all of a sudden the price of oil just magically just started to fall for no real apparent reason that I could see. And so I have a sneaky suspicion something was agreed to where the U.S. is committed. And I've read this in other places. I'm not, this is not my own original thought necessarily, but that I think the U.S. is committed now that we're there with warships because of Israel, and that we are committing greater military protection for Saudi Arabia, and in return for that military protection from those that want to harm Saudi Arabia and others. Because Saudi Arabia has a lot of excess capacity. I think they came to an agreement that their job in this agreement is to get the energy price down to something that's more palatable for the current administration heading into an election year. $100 barrel oil is very problematic. Low to mid 70s crude oil is not problematic. That will work. And I just have a very sneaky suspicion that when you look at the timing of these meetings, the kind of high-level talks, and then magically the bottom falls out for really no apparent. Yeah, people were making up stories. It's the economy. All that stuff was there before, Casey. It's just all of a sudden it just fell, and right. I just think something was agreed to because the Saudi Arabia can do this to the crude oil market anytime that they wish because they have that power and supply and capacity to do that. That's my speculation. I can't say it's correct for sure. I don't have any inside knowledge on it, but my suspicion is there's a concerted effort to keep energy prices down through the election, and after that, I would think that the upside could be explosive because once you become president again, well, you don't like it now, that's fine, but we'll worry about it 4 years from now.
Yeah.
That's my speculation, Casey. But I think there's some validity to what I just said. It's the only thing that I could see that explains how you can have whatever $15 drop in for really no change, material change that I could see in the marketplace, other than high level talks back and forth with a country that has the ability to impact and alter the price of oil in Saudi Arabia. That's my speculation. So,
yeah. All right, let's talk one more thing here real quick. Let's talk soybean meal and crush rates and those kind of things as we start looking in. We start going through as harvest starts rolling in. We start looking at crush rates. Where are we at on that right now? Because we had this big boom with soybean oil and biodiesel and this, that, and the other thing. And we've seen some palm oil stuff come out where we've seen different articles about reduction in palm oil and those kind of things. So I guess as you're looking at the vegetable oil market and crush rates and those kind of things, Shawn, what do you see happening there? And what are your thoughts moving into, post-harvest supply?
Well, just remember a year and a half ago, when we had all the excitement over renewable diesel, jet fuel to the moon, all that sort of thing, and they gunned the oil market to record high prices.
Yeah.
With the idea that we were going to have a record, and of course that was creating a record crush at the time. And what was that doing? That was producing more oil, and at the expense of too much bean meal. And as you know, the oil to meal ratio got to a record level, meaning that the bean oil price, traded a record premium to the bean meal price. And then all of a sudden the EPA and the administration started to have an issue with food for fuel. And in the June report this year, the final report on mandates for U.S. renewable diesel, the EPA basically not fumbled the ball. They backed away and said that in the next 3 years, we're not really going to increase the mandates a whole lot. We're just going to kind of kick the can down and see how everything plays out. And that ended it. It doesn't mean the demand for oil is not strong, but it's not going to be the parabola that everyone thought. Because if you don't have the mandates, if you don't have the subsidy added to the refiners, you're not going to be able to make a lot of money. So once that happened, or once that decision took place, it ended the oil euphoria. And so the oil market, the bean oil market, has now deflated, getting back to a more realistic view of what's likely going to be the 3-year trajectory for renewable diesel based upon the current mandated expectations. What does that mean? That means the crush goes down. Well, if the crush goes down, you're producing less meal. If you're producing less meal, it's less supply. The meal market gets a little bit of a bid. And so we started to see the oil meal spread start to narrow. But remember, Argentina had a half crop in soybeans last year. And they don't sell soybeans. They sell meal and oil. But they really sell meal. And that dearth of export supply is hitting the market now into the spring, meaning there is no supply coming out of the largest exporter in the world for bean meal. So the only one that really has meal to sell in large quantities is who? Us. So our exports of meal are going through the roof because of this. So then, oh wow, the crush rates went through the roof because the meal market's starting to take off because of the shortage from Argentina. Let's do maximum crush. And now we're seeing maximum crush rates to produce the meal. And now we're producing too much oil. It's exactly the opposite of where we're. And now the meal oil ratio is starting to get to the opposite extreme. So there's really no way that I see that that's going to be alleviated until Argentina harvests the next soybean crop, assuming it's going to be a better crop. And I believe it's going to be, it may not get all the way back to normal, but I think it's going to be a solid crop. And they're going to have meal to sell, let's say from the spring onward. Okay. Once they get back into the export market, this whole thing will start to normalize again. So, about a month ago, we had talked about on your show and also in my report about, livestock just locking in meal because we were getting capital flow signals and we were seeing this potential coming up that we could see a big spike higher in meal prices based upon this shortage. And we've been seeing that. Having said that, we're starting to get the market up into this, mid-upper 400s. I think $500 would be a maximum overshoot, Casey, on this scenario. Fantastic right now in terms of actual demand. It's good for the U.S. because of the shortage, but the actual demand isn't that great. I don't think we're likely to see the prices for meal in the nearby, being able to get over that $500 mark. I'd be very surprised. So I guess where are we at? I think we're getting pretty close to pricing in the spread maximally. And I think we're getting pretty close to pricing in meal to address the shortage. And for those that can pull back on meal demand, look, you can use canola meal. There's other things you can do. You can change rations. And believe me, dairymen are going to reduce some meal rations and they're going to figure out ways to use less. That's what the market is doing right now. It's telling everyone, if you can pull back on your meal demand, please do. We just need to get through until Argentina harvests the next crop. So I think we've had the reaction that we were looking for, Casey, in terms of the spread and the nominal price. I think most of it has already happened. I don't think there's a lot more opportunity there. The only thing that I would say on that front is keep an eye on Brazil. If Brazil has a major weather market for soybeans and soybeans really, really take off, that's where you could see the crush margin shrink, right? Because the crush margin is a function of the beans that you pay versus the output of selling oil and meal and making that net spread. If we see the oil the soybean price take off, and it's outperforming meal and oils. I believe that it will, and you start getting a compression of crush rates, or crush profitability, then the demand could start to fall off. So this is a lot going on here. But bottom line, to say that I think that the meal market is kind of leading the soybean market. So the meal market went up first, then the soy market's going to come up, and then the meal market's going to back off. And then I think it's kind of a yin and a yang situation here, as it often is, where meal leads soybeans up and leads soybeans down. It's not unusual for the meal market to do that in the soybean complex.
Right on. Okay. Well, Shawn, good stuff as usual. If folks want to reach out to you and get more information about what it is you're doing over at Hackett Financial, what's the best way to do that?
I'd say the two best places is our Twitter page at Faradix11, or our website, HACKETT, Hackett Advisors with an S, .com. And we have interviews and different sample reports that people can look at, and interviews they can watch to see if the way we look at the world in agriculture might be of value to those watching and listening to your show.
Right on, man. Well, Shawn, I really appreciate you being on the podcast, man, and I look forward to talking to you next week.
Sounds good, Casey. Thanks.
Right on. I'm Casey Seymour with Moving Iron Podcast. Check me out on Facebook, Twitter, and Instagram at Moving Iron LLC. Go to LinkedIn at Moving Iron Podcast and check out the YouTube channel, which is the Moving Iron Podcast YouTube channel, where you can see the video version of this very podcast. Go to movingironllc.com for everything Moving Iron related. And if you want, there'll be some announcements coming up there. You're supposed to have a new website up here, hopefully by sometime in January. And we'll get that taken care of, and we'll go from there. But with that, I'm Casey Seymour with Shawn Hackett. Let's move smart, folks. Out.
Moving higher in the 21st century.